Hello and welcome to Financial Express. I am Shaleen Agrawal. We are talking to Kalpen Parekh of DSP Mutual Fund today. Kalpen, thank you for joining us.
Thanks, and thanks for speaking to me.
Kalpen, you recently posted a very interesting tweet. You wrote that Nifty TRI had given a return of 2,243%. Berkshire stock has given a return of 2658%. But if you split the money 50-50 between the two, your returns would be 3466. That is way more than even the highest generating returns of the two securities. Is this true?
If it wasn't true, I wouldn't have tweeted it. Obviously, this is data. And the nuance here is that, Berkshire's actual return may be similar to Nifty, at times even lesser. But it gets accentuated with the fact that when you convert those dollar returns into rupee returns, you get the advantage of another 3 to 4% of extra compounding every year that comes because of the appreciation of the dollar in relation to the rupee. So, at large, in most years, I think barring 4 or 5 years in the last 20 years, the rupee may have depreciated. So these are investments done in dollar terms, and hence relatively the dollar has appreciated. So that adds to your return, number one. Number two, the more important point that I wanted to highlight, it is not about 2,200% or 2,600%. When you blend two good investments, see, Nifty in itself is a proxy to India's growth story and, the good companies of India and the growth of these good companies. And it will have its journey in the next 10, 20 years, depending on how corporate profits play out. On the other hand, Berkshire is a proxy of sensible investing done globally, and within that mainly in US by one of the investors who has been doing this for 75, 80 years. And a lot of us have learned a lot of good investing principles by reading his history and books and guidelines. So, when you blend two good investments, logically, A plus B ka average mathematically should be A plus B divided by 2. But many times what ends up happening is the average of A and B, if it is able to deliver more than A or more than B, is where the nuance and the magic is. And this is the magic of mixing two good asset classes, but which have relatively lower correlation to each other. Which means that, in the short term, these two asset classes move in opposite direction of each other. In the long term, they have both risen. In the long term, let's say both of them would have delivered around 12 to 14% rupee return, CAGR, over a long period of time, which means the slope is upwards for both of them. So both are directionally moving in the same direction long term. But there are years in between when, Nifty will rise for 2-3 years and Berkshire will not, or global stocks will not, and vice versa. And that is called low correlation. So the correlation between these two asset classes is low. So now when you mix A and B together, or in this case, N and B, N is Nifty and B is Berkshire, when you mix them together, it so happens that the average of these two is higher than the individual unit because they have relatively poor correlation to each other. And this is the classical advantage of diversification. See, many people wrongly interpret diversification as if, you should own everything. If you own bad assets by diversifying, it's not going to help you. So when you diversify, all the underlying assets should be good. In this case, Nifty and Berkshire both are good individual asset classes. But because of their poor correlation to each other, when you mix them together and then rebalance every year. So, this also happens because you're rebalancing, which means, let's say you start with, 100 each. So your unit total amount is 200. And in a year, Nifty goes up by 15%, whereas Berkshire has gone down by 15%. So what would have happened is 100 has become 115 of Nifty and Berkshire has become, let's say, 85. So the gap is almost 30 rupees between each other. And when you rebalance and bring it back to 100 each, which means when Berkshire is underperforming, you move more money into Berkshire and you take that money out of Nifty. Likewise, when the reverse happens, you do the same again. So when you keep doing this, every 2-3 years of rebalancing, eventually the outcome is, a lower volatility and relatively similar or better return. So I think in a nutshell, that is the concept. And the reason for putting out that message was to highlight that, highlight two things. One, the future is generally unpredictable. The present rarely gives you insights about the future. So there are times like today when we speak very gloriously about Indian equities. And there were times few years back when we would have spoken gloriously about US equities. Now, the last year, US equities actually came down by 15 to 20%, and Indian equities went up. And beginning of this year, the trend is again reversed. So these short-term trends will keep changing. They are rarely predictable. So what is important is to diversify. What is important is to diversify around good rules, good principles, mix these asset classes. And here I've just taken the example of broadly two buckets. Both are the same asset class of equity, but what is different is their geographies are different, and to some extent, some business models are different, which means their path may be opposite to each other in the short term. Another nuance you can add is diversify by adding gold into this combination. That will, probably further reduce the volatility of all the three. The fourth asset class you can add could be fixed income, for example. When interest rates are high, if you add fixed income as a variable, that will still bring down the volatility of the combined portfolio. So I think the key message was diversification helps in reducing volatility. At times, it also reduces return, but for the volatility that it reduces, it is precious to look for diversification.
Very, very interesting, Kalpin, and very nice insights into this entire thing. And this actually is very similar to what we spoke a few months ago when we discussed Ray Dalio's all-weather portfolio about correlation and diversification. Sure. Before we move ahead, just a clarification. The returns that you wrote for Berkshire in this particular example, 2,658%, that is rupee returns, that is not dollar returns.
Rupee returns.
So I want to clarify that for our viewers that eventually all three figures are the rupee percentage, rupee returns here. What I'm also hearing here is, other than diversification, what is also key is rebalancing at a certain frequency. If it were not for rebalancing, then these returns would not matter, right?
It may still matter because both independently have given, reasonably good long-term compounding. Sure. But rebalance just adds to the magic. It just adds to the value of asset allocation. And what is the principle? See, rebalancing is a very jargonized word. Everyone says rebalance. Everyone says asset allocate. But what is the substance of rebalancing? What it is effectively doing is it is buying low and in a way selling high. So when you rebalance, what are you doing? You're moving some money from an asset class or an investment which has risen in this cycle and giving it to the asset class which has not risen. But the fundamental principle is that in the long term, both asset classes should rise. On the other hand, let's say if you rebalance into another third asset class or stock, which over the long period would have declined and become zero. Let's say it was Enron, for example. It has all the ingredients of international diversification, large company, reputed company in those days and all of that. But eventually it became zero. So any diversification there and rebalancing would have only hurt you. So the first principle is that the underlying asset classes have to be sound. Their long-term prospects have to be positive. And when you rebalance, you are actually taking money out from the asset class which has done better in this cycle and giving it to an asset class which has not done well. And finally, another principle that this is trying to highlight is in the long term, mean reversion is a very powerful force in nature and in investing. What does well in this cycle generally underperforms in next cycle and vice versa. You see that happening with styles like value and growth. You see that happening with countries like developed markets and emerging markets. There are years when China does very well and US doesn't do very well and vice versa. It happens between asset classes like equity and bonds. There are years when bonds will do well and stocks will not do well. It happens between active funds and passive funds. There are years when active funds will do very well. And there are many years where passive funds will do very well. What unfortunately happens is the mistake that a lot of us as investors make is whatever is doing very well right now, we extrapolate that. Versus using the principle, what I try to say is that these forwards are very important. Whenever an asset class has done very well or poorly, the forwards to repeat to yourself is this too shall pass. So a good asset class will slow down in the next few years. A bad asset class will turn around. provided inherently they are governed by sound investment principles.
Just sticking with this example, over what periods did you calculate the returns?
This was since 97. Now, you should question why 97. Was it my date of birth? No. I would have been 25 by then. I wish I had done these investments and I would have compounded wealth more.
You're doing it for your son. I regularly see your tweets. So
yeah. So this was 97 because I think, we have this internal charts tool where I keep testing for these type of inferences. And the data available in that tool for Nifty was since 97. Berkshire data is available for a longer history, but Nifty data was available since 97. But if you would have done the same exercise in the last 20 years also, more or less similar results you would have got.
Sure. And
one more point I'll add, between 2001 to 10, Nifty would have earned 2 times higher return than Berkshire. Okay, so if you were doing this interview in 2010, most likely I would have not even tweeted this because I would have had no courage to tweet because Nifty returns was 2x of Berkshire. So, वो दिमाग में thought ही नहीं आता. And in the next decade, 2010 to 20, Berkshire delivered 2 times return of Nifty. So over 20 years, both have averaged out. But collectively, the average has delivered better.
On the point of rebalancing, so one way of rebalancing is to take money out from this asset which has risen a little and put into another asset which has risen either less or has fallen. Another way of rebalancing is to maybe put more money into this asset which has risen lower. Absolutely. Is that a prudent strategy?
So yeah, I think so. It's a function of your cash flows. Like we may not get new cash flows all the time. And let's say on day one we started with 100 rupees, and 100 has got reset by 10% deviation. So you can have some very crude hacks or rules like whenever the 2 asset classes deviate by more than 10% is when you rebalance. Or your new investments, you then do it in a ratio of 90, 110, so that the total ratio still remains 50-50. You could take a call that I still feel that over 20 years, Nifty still may do better than Berkshire. So I don't want to do 50-50. I want to do 70-30 or vice versa. So, there is no science to what that ratio should be. It is a function of your judgment, comfort, and, what you prefer a lot more. So, we have a fund where 70 rupees is invested in good Indian companies and 30 rupees is invested in good global companies, where one of the stock is Berkshire. And then the second portfolio is a similar fund manager called Veritas, and then Little Train. So whenever I have new money in terms of my salary or annual performance pay, if in the last year the global slice would have underperformed, I would like to add more in the global slice. If in the last year the India slice is underperformed, I would like to add more in the India slice. But this is not very easy to do because 99.9% of us like to invest in what has done well, because it gives you the comfort कि हाँ जिसने अच्छा किया है वो अच्छा ही होगा आगे. मुझे भी 12 साल लगे थे इस आइडियोलॉजी को चेंज करने के लिए टू मेक इट उल्टा कि अगर इनहेरेंटली दोनों अच्छे हैं, अगर दोनों प्लेयर अच्छे हैं, विराट कोहली भी अच्छा है, रोहित शर्मा भी अच्छा है, and if I have to select for the next IPL team curation, then the one who is not doing well right now, I will take them because वो सस्ते में मिलेगा, उसका भाव बढ़ा हुआ नहीं होगा, and eventually because he is good, he will deliver. So in investing, I repeat again that these two principles are important. Both need to be good, and invest more in who is currently not good, he or she, whoever is currently not good. So invest in underperformance is the message.
Why is the correlation very low between Nifty and Berkshire?
It's not about Berkshire. It could be Nifty and S&P. It could be for Nifty and MSCI World also, because they have their profit pools coming from different economies and different markets, and the investors investing in these two markets also sometimes are different. So the investors in US markets will be relatively more global investors. The investors in Indian markets will be very largely Indian investors. So both have in the short term different prospects. Again, in the long term, both the economies may have similar prospects, but there are years when, because of good news in India, good policies, or 1 or 2 years of good budgets, or a dominant government coming back with majority, in those years Indian markets may have done very well, whereas the US market is just going through a slowdown. There could be years when there is an announcement that Trump is coming back to power and US markets will underperform. So a lot of these individual nuances can keep playing out. Plus, the sectors for both these markets are very different. The largest weight in India Nifty is banking. The largest weight today in US, for example, is technology, tech and consumer tech. So Amazon, Apple, Facebook, these are all in a way consumer and technology business models together. Whereas in India, it is banking. Now, in the last 5 years, banking system in India almost got washed out because of a bad NPA cycle and then the cleanup. So for 5 years, we were repairing and healing. So our markets were going nowhere. And in these 5 years, global tech and US tech was actually, winning all over the world. And they were becoming trillion-dollar market cap companies backed by very solid fundamental profitability and growth. So India's profitability was coming down and US profitability was rising. So hence their stock markets also behave very differently. So the reason for weaker correlation is business models are different. But if the sectors are the same, then you will not find relatively low correlation. So you'll notice that whenever US tech stocks come down, generally Indian tech stocks also more or less mirror that trend. So, and also in India now, almost 25% of our market cap is owned by FIIs. So generally, and they are also the owners in global markets. So sectors more or less move together. Energy stocks move together, tech stocks move together. उसके बाद थोड़ा बहुत nuances अलग होता है, but at large sectors have a very similar trajectory. So because the constituent of the indices are different, the journeys will be different, the paths will be different. Like for Taiwan, the destiny of semiconductor as an industry will determine how their stock market cycle will be. India doesn't have a single company in the semiconductor space, and so on and so forth. In Europe, for example, it will be mainly engineering companies and consumer brands, and the best of luxury brands. Now, India doesn't have luxury brands. India has many consumer retail brands. So their journey and path sometimes will be different than our journey and path, which is why the next takeaway of this is that as an investor today, you have an opportunity to invest in the best companies of the world, including India. So our duty or responsibility as investors should be to choose the right companies at the right price. So there are times companies in India are priced right and companies globally are mispriced. Like technology globally was getting mispriced 1 year back because of the bubble which was building up there. So it was not right to invest there just looking at their 10-year returns. And there are years when companies globally are cheap. Like in the last 6-8 months, Indian companies had run up. Indian markets was at all-time high, whereas US markets were down 15-20%. So I think these are reasons why a low correlation exists, and you can take advantage of that.
And this is exactly why you would have bought, if one kept rebalancing, one would have bought good assets at lower prices in different points of time and multiplied returns.
Absolutely.
You mentioned tech stocks. US tech stocks have run up quite a lot in the last 10 years, actually. Do you think there is a case for further valuation re-rating, either in terms of correction in prices or in terms of time correction? And if that happens,
re-rating का तो scope कम है because that whole bucket has got a decadal re-rating. They've all run up and they are the largest market cap companies on earth. And generally, every 10 or 15 years, you will see the top sectors go through a churn. So in 2000, the top sectors were the .com companies. Some of them have remained, some of them have perished. Then 10 years later, the top 5 companies were energy companies, oil companies, gas companies. They were the largest. Then, this decade, the decade ended with, again, tech companies winning over leadership. So these leaderships will change. It has got nothing to do with 10 years ka cycle because markets or profits ko wo date se kuch lena dena nahi hai. But it is a fact that a lot of these companies have become reasonably overpriced, and thankfully they corrected also. So now they are normalizing. But they still, I don't think you can continuously see valuations, going to the sky or getting re-rated. So incrementally, their returns now will be more of the profit growth that they earn. Rather than profit growth plus re-rating. De-rating also to a large extent has played out in the last 1 year or so. So now they are somewhere in the middle. They are not very expensive. They are not very cheap. They are like any other business. And, once in a while you get opportunities like Facebook, Meta, which became very cheap. It almost came at single-digit price to earning multiple. And yesterday they had a good result. I think they announced some buybacks and the stock was up some 20% after market hours. So, when you become an investor thinking around the world, you do get opportunities like this where, good companies sometimes become very cheap and you can add to your portfolio.
Which is where my next question is. So when the next churn happens in the US stock cycle, then is there a chance that other sectors which have not done so well in the last 10 years, they will come up, and then hence this correlation that we spoke about between Nifty and let's say S&P 500, that will again become very similar if there are similar sectors in the next churn?
So generally, we have not seen similar sectors to India. Like I said, in India, even today, the largest sectoral weights are in banks, NBFCs, and housing finance companies. And then the next weight is India Tech. And India Tech is still very different from US Tech, because India Tech is more enterprise tech, and those guys are more consumer tech. Now, I was reading some data point yesterday that if you take out the top 5 companies of S&P 500, the valuation dropped by 30 or 40%. So, many of the companies in US in the last 10 years have not participated. A lot of their brick and mortar businesses, their pharma companies, their banking sector, they have actually underperformed. It is only some of these dominant companies which have been winners. So I think more than the country or the sector, what is important is to look at companies in a unique way, that which are those 50 or 100 companies available globally on 2 principles. They are good companies and they are available at good prices. As long as these 2 are tick marked and you keep owning them, generally your long-term compounding is well taken care of.
You said at DSP you have a fund which has 30% of money in US stocks. But is there a product available at DSP or anywhere which has simple 70% or 50% of money in Nifty 50 and 50% or 30% of money in S&P 500?
See, such hybrid funds are still not prevalent. And,
but if your own calculation shows that this is the magic of these returns, then why not?
No. So we still feel that, inherently Indian market is in its phase of discovery and becoming relatively more mainstream. Over time, more global investors will come in and buy Indian companies. So one, there is more familiarity to our own companies here, and our growth prospects are, reasonably solid compared to the developed world. So it is, remember, on day one, our exposures to global stocks was 0 till the last 2-3 years when it started, moving up. So we have 2 types of funds. One where 100% of the portfolio is in global stocks. So we have a fund which invests only in US market. But it's not an index fund, because we still prefer active management over an index. Because, over very long periods of time, there are many of these indices, like you look at the Japanese index, the Chinese index, the Hang Seng, the European index, the indices for 10, 20, 30 years have given 0 returns. But if we are able to identify fund managers there who are able to extract returns from flat markets, that is the first objective that we would like to incorporate in our portfolio construction. So we have few funds which invest in only in US. We have one fund which invests in technology and innovation companies around the world, which is called Global Innovation Fund. So these are dedicated global funds. And then we have a couple of funds where we mix 30% of global stocks and 70 is India, for 2 reasons. One, our familiarity with India is a lot more. So as investors, if you want to take that full leap, you have the global range, fully 100% global range. If you don't want to take the full leap, you can do 50-50. So there is no science ki why 70-30 and why not 50-50. It could have been 50-50 also. Nothing wrong about that. The other advantage that you get with a 70-30 portfolio is the taxation of that structure is that of equity and hence more tax efficient. So that is one minor benefit of a 70-30 structure.
Sure. Rebalancing, isn't that inherently expensive if you do it very frequently?
Of course, which is why, it should not be done frivolously and frequently. It should be done strategically over a 2-3 year cycle. So my view of rebalancing is that do it when the distance between the 2 asset classes becomes very wide. Now, if both have gone up at a rate of 12% or same rate of growth, then your 50-50 remains intact or 70-30 remains intact. Whenever that ratio, changes because of price movements, very sharp price movements, from 70-30, it becomes, let's say, 65-35, or it becomes 60-40. Then at that point in time, I would like to rebalance.
Sure. Um, for next 5 to 10 years, for an investor who's willing to take a little bit of risk in equities, what should be the ideal asset allocation?
See, there is no such answer because there are hundreds of people who will be listening to this answer, and each person's context and cycles are different. So one answer does not suit all. But generally, like my personal asset allocation today is a bit. If I have to just take equities, is around is almost 70-30 between India and global. So I'm at 70-30, but if let's say whenever I have the next round of capital to invest, I will stick to 70-30, or I could make it 60-40, or I could go to 80-20, depending on which is the market which is underperforming at that point in time.
Understood.
But
and
I think to keep it very simple, what investors should do is because not every investor will have the temperament to live through some period of underperformance of the individual underlying market. Many times people panic when they see 1 year of return being very poor, whereas that is actually the time to add more. So ideally, my first message to everyone would be to start with a 70-30 product, because that fund itself will do the rebalancing for you. You don't have to worry about when to do it, whether you're doing it the right way or wrong way. You end up paying tax, you end up having exit rebalancing costs. So if you're in a 70-30 product, the rebalancing is far more tax and cost efficient.
Final few questions. Can it be done at scale? Investing in different asset classes, different markets, and rebalancing?
Of course, it can be done in scale, because remember, global markets are far bigger in size than Indian markets. So it definitely can be done in scale. And like I said, if rebalancing is done thoughtfully and not frivolously and frequently, it has to be very strategic. So once in 2, 3, 4 years, once in 5 years sometimes, once in a while, once in 6 months. Let's say you started investing today and suddenly there is a crash in global stocks. Then this is the time to take advantage of that. So any market which moves sharply, at that point in time, you start thinking about rebalancing.
Last question, very quickly. What is the long-term outlook for Indian equities and long-term outlook for US equities?
See, there are two things. Any equity market of good underlying economy and companies, where companies are innovating and growing, is long-term good. And in the short term, the outlook always is that they fluctuate. The outlook is very random. Every year, if beginning of the year you were to ask me, will markets go up or down, whatever answer I would have given you, the odds are 50% of times I would have gone wrong. Because in the short term, markets fluctuate through randomness. It's like a random walk. There is no firm path which you can predict in advance. So my view is that in the long term, equities create wealth. In the long term, equities beat bonds. In the long term, equities beat inflation, because fundamentally equity is about owning businesses, and good businesses have pricing power. They are able to grow profits. And what is inflation? Inflation is our expense. What is our expense? Our expense is the profit of companies. Because when we spend money on buying goods, it is the companies which are making revenues and profits. So the best way to beat our expense is to partner with businesses, and partner with those businesses whose products you and I like. If I like lots and lots of Apple product, Microsoft product, Amazon product, HD banking products of India, paints, you keep partnering with these businesses. So in the long term, good businesses always win, whether of US or in India. The only challenge is many times when it becomes so obvious that equity investing is good, what ends up happening is the stock prices run up ahead of expectation, and they run up much faster. So when that happens, the valuations become very expensive. So our markets have generally been more expensive than their past history, and to that extent, I would have a slightly moderate outlook for the next year or two. But if I think from a 5 to 10 year point of view, my personal equity exposure overall between global and India and all put together today is around 65 to 70%. And the balance 25 to 30 is in gold and debt funds, because of the view that the next 1 or 2 years could have some consolidation or some phase of. And then secondly, when I keep money in debt, I'm getting rich compensation of 7.5 to 8% today, because interest rates have risen. So my parking assets are also giving me decent returns. So even if equity gives me 10 and bonds give me 8, I'm not too worse off. I'm worse off if bonds give me 3 and equity gives me 12. So that gap has narrowed down to some extent right now. So which is why I'm slightly conservative in terms of a 70-30 exposure right now. But this is my personal exposure. It could be completely different for both of you.
Kapil, we'll end it here, but to our viewers, we'll again see a lot of traditional wisdom in this conversation. Diversify into low correlation assets, but the assets have to be of the sound quality, sound in nature, and keep rebalancing, but not too frequently. Keep rebalancing strategically. Kalpin Parikh, thank you so much for joining us today and sharing those insights.
Thank you, Shaleen. Thank you, Zoya.